Online boat listings are exploding, up 65% in just 2 years, while dealers claim the market has never been hotter. But the prices you see are frozen in 2021 fantasy, held in place by secret dealer policies that ban discounts and force call for price tactics. Real demand collapsed back to 2019 levels, yet the sticker prices refuse to fall. This is what the boat industry does not want you to know. The true scale of the inventory crisis is just beginning to show. Why are dealers risking everything to keep the illusion alive? Boat listings didn't just trickle up, they exploded. Over the past 2 years, the number of boats for sale on major platforms jumped by 65%. That is not a rounding error or a seasonal blip. It is the loudest alarm the market can send. Every week, new hulls hit the web, piling onto a digital backlog that grows longer by the day. Dealers keep telling the same story. Inventory is tight, prices are firm, and you had better move fast. But the numbers tell a different story, one they cannot hide behind showroom glass. Scroll through Boat Trader or Yacht World, and the pattern is impossible to ignore. Models that used to vanish in days now linger for months. Listings that once felt like rare finds now crowd every search result. It is not just the high-end yachts either. Entry-level pontoons, wakeboats, center consoles, the entire spectrum is up for grabs, and there are more choices than at any point since before the pandemic. This is not natural market growth. It is the aftermath of a buying binge that ran out of steam. Manufacturers ramped up production in 2022 and 2023 to chase COVID-fueled demand, but by 2025, the party was over. Sales of new powerboats dropped nearly 10% last year, and pre-owned sales fell too. Yet the pipeline kept flowing. Now the market is flooded with leftovers, boats that dealers cannot move and owners cannot offload. A 65% surge in visible inventory is the crack in the mirror. It is the first proof that the market is not as tight as sellers claim. If demand were real, these boats would not be sitting. Instead, they are stacking up, quietly rewriting the rules of negotiation. The oversupply is out in the open, but the real manipulation is just getting started. Dealers are not just hoping you will pay the sticker, they are engineering an illusion that you have no other choice. The biggest tool in their arsenal is called MAP, Minimum Advertised Price. Under MAP, every dealer must list boats at the same high price, no matter how desperate they are to sell. Even if a dealer is drowning in inventory, they are banned from showing any public discount. The policy is not about fair competition, it is about protecting the value of every loan on the books. If prices drop on paper, banks start asking questions. So the discount is buried. You will see call for price instead of a number. Ask for a deal, and suddenly there is room to negotiate, sometimes tens of thousands of dollars below the listing. But on the internet, the illusion holds. The $200,000 boat stays at $200,000. The system is designed to keep buyers in the dark and lenders off their backs. This is not a new trick. In 2021, during the post-pandemic frenzy, dealers locked in those high stickers to chase the boom. Now, with demand gone, they are stuck defending those numbers at all costs. Price cuts happen behind closed doors, whispered between salesmen and serious buyers, never published online. That is why the gap between asking price and actual sale price is wider than ever. The public sees a seller's market, but the real market is falling apart behind the scenes. Every time you see call for price or a suspiciously round number, understand what is really happening. Dealers are freezing the sticker to protect their balance sheets. They cannot afford to admit how deep the discounts go, because the moment they do, the banks, the manufacturers, and every other dealer in town will feel the pain. The game is about hiding the real price until the very last minute, hoping you will blink first. MarineMax's latest earnings call sounded calm, but the numbers tell a different story. The headline figure, 34.7% gross margin for the quarter, looks strong at first glance. Dig deeper, and the cracks start to show. That margin is propped up by everything except boats, marina fees, insurance, and superyacht services. Strip those out, and what is left is a retail boat business under siege. New boat sales have slowed, and the margins on each sale have been squeezed by inventory costs, rising interest rates, and a buyer pool that is shrinking by the month. In previous years, selling a $200,000 boat meant a dealer could count on a healthy cushion, roughly $60,000 in gross profit before expenses. That cushion has been cut down sharply. MarineMax's CFO described it as significantly lower boat margins, not in a press release, but in the fine print of SEC filings and during tense Q&A sessions with analysts. The old playbook, move inventory fast, pocket the spread, and let service revenue fill in the gaps, no longer works when boats are sitting 240 days or more. Every extra month on the lot racks up floor plan interest, eating away at what little profit remains. At today's rates, holding a $200,000 boat for half a year can burn through $4,000 or more in financing costs alone. That is before paying sales staff, insurance, or even keeping the lights on. MarineMax's overall gross profit for fiscal 2025 was $750 million on $2.3 billion in revenue, but the retail boat segment dragged those numbers down. Revenue from new boat sales dropped, while services and used boats picked up the slack. The company's own filings admit the truth: new boat sales and pricing under pressure in soft retail environment. The result is a margin profile that is the second lowest for new boats in nearly 3 decades, masked only by the growth in higher margin segments. For every $200,000 boat sold, thousands in profit have vanished compared to the peak years. The cushion that once protected dealers from a slow month is gone, replaced by a razor-thin line between red and black ink. This is not a blip, it is a structural problem. The more inventory piles up, the more each unsold boat becomes a liability. Dealers cannot lower prices publicly without risking their entire loan portfolio, so they play defense, hiding the pain behind bundled services and creative accounting. But the math does not lie. The profit that made this business safe for dealers has evaporated. The risk is now squarely on their shoulders, and they know it. Brunswick's name is stamped on nearly every dock in America, but even the industry's biggest engine can't outrun gravity. After years of chasing pandemic-fueled demand, Brunswick's leadership made a quiet admission in their latest reports. The pipeline is clogged. Instead of ramping up, they are pulling back hard. The company announced a production adjustment that will keep thousands of boats off the assembly line. This is not a seasonal slowdown or a tweak to the schedule. It is a deliberate retreat from the numbers they once bragged about. The specifics matter. Brunswick is holding back an estimated 2,200 units from its 2025 run. That is not just a blip in output, it is a signal flare for anyone watching the supply chain. For a company that typically ships over 200,000 boats a year across its brands, cutting over 2,000 units means something broke in the demand equation. The stated goal is to save $10 million in costs, money that would have been spent building inventory that, by Brunswick's own calculation, stands little chance of moving at full price. This kind of move does not happen in a vacuum. Manufacturers only cut production when their dealers are already drowning in unsold stock. Brunswick's leadership described dealer inventories as lean in their official guidance, but the numbers tell a different story. Even with these cuts, lots are still packed with model year leftovers. Wholesale shipments have stabilized, but only because the company is matching output to a market that is already saturated. The cost savings, $10 million, are not coming from some new efficiency or breakthrough. They are the result of shutting down lines, consolidating plants, and quietly reducing the number of models shipped out. That money is not profit, it is a lifeline, a way to stop the bleeding until demand returns. Brunswick is not alone in this playbook, but as the biggest name in the business, their retreat is a warning shot for the entire sector. When a manufacturer as large as Brunswick steps back, it is because the math is impossible to ignore. They are not betting on a quick rebound. They are bracing for a long stretch of oversupply, one where every extra boat built just adds to the pile dealers cannot move. The production pullback is a confession. The market is overbuilt, and the only way out is to slow the flood at its source. Picture a listing for a 2022 center console, still gleaming in the photos, with a price tag of $110,000. The owner bought it at the peak, financing nearly the entire purchase. 2 years later, the loan balance sits at $100,000. But the market has moved on. Comparable boats now close for $70,000, sometimes less. The numbers do not add up for anyone. Selling at market value means writing a $30,000 check just to get out. Listing it high is the only way to avoid a loss on paper, so the boat sits month after month, gathering digital dust. This is not a rare case. The math repeats across thousands of listings. Every time a buyer scrolls past a $110,000 boat that is really worth $70,000, they are looking at a ghost fleet boat. The seller cannot drop the price without taking a huge financial hit. Dealers will not advertise a real discount because the bank is watching. The boat becomes frozen inventory, unsellable at any realistic number, but still counted in the official totals. Multiply this by every owner who bought during the frenzy and financed at 90% loan to value. The result is a shadow market, listings that will never clear at the ask, clogging up the data, distorting supply, and trapping both seller and buyer in a standoff. This is how the ghost fleet builds, one underwater loan at a time, each one a mathematical dead end. The only way out is a forced sale, a repo, or a seller willing to eat tens of thousands of dollars just to walk away. The scale of the backlog is hiding in plain sight. Dealer inventory reports show a surge that is impossible to ignore. Lots that once turned their stock every few months are now sitting on a mountain of unsold boats. In 2024, the number of pre-owned boats listed for sale in the United States hit 858,000, an all-time high. That is a 60% increase from the pre-pandemic average, and the flood has not slowed. Each week, more boats are posted, and what is more telling is how many of these listings are recycled. The same hulls appear, disappear, and then pop up again, often at the same price or with a minor markdown, as if nothing has changed. This relist pattern is not a coincidence. It is the digital version of moving inventory from the front lot to the back fence and then wheeling it out again when buyers walk by. Marketplace logs reveal that some boats are relisted 2, 3, even 4 times in a single year. Dealers swap photos, rewrite headlines, and reset the clock on days listed to give the illusion of fresh inventory. But the backlog only grows. The average time on market for a used boat now stretches past 5 months, and in some segments it is even longer. These are not just slow sellers, they are evidence of a market that is choked with excess. When the same boat keeps reappearing, it is not because demand is strong. It is because nobody is willing to pay the sticker, and the dealer cannot afford to show how desperate things have become. Behind every relisted boat is a silent admission. The market is saturated, and the old tricks are not working. Pontoons and wake boats have always been the backbone of the American boating market. They are the entry point for families, weekenders, and anyone seeking a slice of lake life without moving into the luxury tier. But the numbers coming out of 2025 are a wake-up call. Sales in these segments are down 15% year over year, and that is not a rounding error. It is a direct hit to the heart of the mass market. Dealers used to move these boats quickly, counting on steady demand from buyers who financed with low rates and who expected their investment to hold value. Now, with interest rates higher and inflation eating into disposable income, those buyers are staying home. Inventory that once turned in weeks now sits for months, racking up holding costs and crowding out new shipments. The slowdown in pontoons and wake boats is not just a blip. It is the first sign that the market's foundation is cracking. When the middle class steps back, the rest of the market takes notice. This is where the dominoes start to fall. Catamarans, once the darlings of the charter fleets, are now the most dangerous asset on the water. The numbers coming from brokers and appraisal data are unambiguous. Used multi-hulls are flooding the market at a rate never seen before. Every major platform shows a spike in ex-charter Lagoon and Fountaine Pajot models. Boats that spent their first years earning revenue in the Caribbean now dumped en masse as operators shrink their fleets. The supply is not just high, it is at record levels. For every buyer, there are 3, sometimes 4, nearly identical boats fighting for attention. The price history tells the story. In 2022, a Lagoon 42 could fetch $600,000 straight out of charter. Today, those same hulls sit at $400,000, often with no offers. Brokers quietly admit that a 30% haircut is not a worst-case scenario, but the baseline expectation for 2026. Appraisers are already using 2019 values plus inflation as their ceiling, not their floor. Owners who bought at the peak are now underwater, forced to either hold and hope or accept a loss that would have seemed unthinkable just 2 years ago. This is not a temporary backlog, it is a structural glut. The ex-charter catamaran market is the canary in the coal mine, proof that even the most desirable boats are not immune to the laws of supply and demand. Anyone considering a multi-hull at today's sticker price is staring down the barrel of a 30% depreciation with no safety net. The brokers know it, the sellers know it, and now, so do you. Right now, sticker prices remain frozen, but the real market is drifting further out of reach for sellers. As inventory piles up and days on market stretch longer, leverage quietly shifts to those who see through the illusion. Dealers cannot hold back the flood forever. In the end, only buyers who question the script will name their own price. What would you offer? Let me know in the comments below.